Hello, I'm Scott Morgan with TAMCO, and in this session I will share a few details about interest rate that will be important to your efforts and success selling as-a-service technology solutions. When you sell a technology solution with a financing monthly payment of any sort, we know one of the first things many customers will ask you about is the interest rate. And if they don't ask, they are probably computing the rate themselves. Given that technology equipment financing has historically focused on leasing programs that result in ownership, the interest rate can certainly be a valid factor in their decision-making process. Unfortunately, there are two common issues with regard to an interest rate that can lead customers to make potentially bad decisions about any monthly payment program. First, they often calculate interest rates incorrectly. And second, they assume there is an interest rate even with some monthly payment programs that do not actually have one. Let's first look at calculation errors, and there are really two big ones that occur frequently. To help you recognize them, let's consider a customer interested in a solution that has a $100,000 total purchase price. They are offered a 60-month financing program with a monthly payment of $1,979. The customer does the math and says 60 months of payments times $1,979 means they will pay a total of $118,740 for that $100,000 solution. And they correctly point out that they will pay $18,740 in interest. So far so good, but here's where they go astray. And before we continue with the customer calculations, this is a good point to see what you think. Don't worry, no one expects you to be an interest rate or financial calculations expert, but based on the details I have shared, which of the following options do you believe is the correct interest rate? It turns out that most customers will divide the interest paid, $18,740, by the cost of the solution, $100,000, and believe the interest rate is 18.74%. And unfortunately, this is absolutely incorrect. The correct interest rate is actually 6.98%. The obvious question is, well, how do you calculate that interest rate? For a lease, a loan, or any payment stream like this, the math is not going to be something you can quickly do in your head or work through on a piece of paper, and you should not get bogged down in and don't need to get bogged down in that math. That is why we have calculators. But you do need a financial calculator or a spreadsheet or a program with the functions designed to compute financial figures such as interest rate. Fortunately, you can use any of the dozens of tools on the internet to do the same calculations that we do with our fancy financial calculators. Here is one example we can use to verify the rate that we claim to be correct. When you go to calculator.net, you will see a variety of calculator categories, one of which is financial calculators. Under financial calculators, select interest rate calculator. I will size the window to focus on just the information we need. We simply input the three values in the boxes above the calculate button. So loan amount, which is the same as lease amount or borrowed amount or the purchase price of the solution, in our case, $100,000. Next, we enter the term. In our case, this is a 60-month term, and here they want the value to be in years, so we will input 5 years. And the last piece of information needed is the monthly payment, in our case, $1,979. Now we simply click the Calculate button, and we see the results section to the right update with the interest rate of 6.976%. Rounded up, this is our 6.98% that we stated. So the point here is, although many customers will divide the total interest paid by the total cost of the solution and assume that percentage is the interest rate, it is not. And you can now easily and confidently show them how to calculate the correct interest rate. While this is the first of the two big calculation errors to be aware of, the second is just as important and dangerous to your sale. The second has to do with what values the customer is using in their calculation, meaning what are they plugging into these three input boxes. And the values they use will rely entirely on you. Let's look more closely at this example. We said that the total solution price and the total purchase price was $100,000. We did not specify what was in that $100,000. Any of the following scenarios and many others are possible. In any of these scenarios, if the term is still 60 months and the monthly payment is still $1,979, then the interest rate is still 6.98%, just as we had calculated. As you know, we specialize in helping our partners sell technology as a service solutions, and a critical element of this type of solution is full-term maintenance support services built into the monthly payment. We do not advocate providing customers with a complete itemization of pricing for every component of the solution. In fact, we don't even suggest providing the total solution price. We encourage partners to lead only with a monthly payment that represents the comprehensive solution, including full-term warranty and support services. Now, we understand that some customers, maybe many customers, still want to see a cash price even if they are considering an as-a-service or other monthly payment option. And this is where you must be sure the total purchase price shared with the customer is the price on which the monthly payment is based. Let's illustrate the potential problem using scenario 3. For this scenario, we will say the $18,000 maintenance and support figure represents full-term coverage, 60 months. Assume a partner presented a customer with the $1,979 monthly payment only, as we recommend. But afterwards, the customer also requested a cash price. What we have experienced is that many partners are afraid to show the cash price with 5 years of maintenance and support bundled in. Instead, they pull out the multi-year support and give the customer a cash quote of $82,000 in this case, thinking that will be more competitive. Setting aside the discussion that this now becomes two different solutions, let's stay focused on what the customer perceives as the interest rate. They see an $82,000 cash price and the monthly payment of $1,979 that was previously provided. Now, when the customer attempts to calculate interest rate, there's going to be an issue. Let's plug the numbers into the interest rate calculation tool and see what the customer comes up with. The customer sees the solution price of $82,000, which they believe to be the loan lease amount that the monthly payment is based on. They know the term is 60 months or 5 years. They were provided the monthly payment of $1,979. If they calculate interest rate using these figures, they are going to get a rate of 15.65%. And of course, they wonder why and complain that the monthly payment and interest rate are so high for the $82,000 solution. But they are not working with accurate inputs to the calculation. Remember, the $1,979 monthly payment is based on a total solution price of $100,000, not $82,000. We can easily avoid this second big calculation error. If you are going to share a cash price and a comprehensive as-a-service monthly payment, the cash price must include multi-year maintenance and support. Otherwise, the interest rate will always be incorrect and extremely inflated, and at the very least, confuse the customer about both options. In addition to interest rate calculation errors, we said the second common issue was trying to peg an interest rate to a monthly payment when there really isn't one. This is more of a conceptual issue and has to do with the purpose of the monthly payment. To make this easy for you and your customers to understand, all you need to remember is two words: own and use. Is the purpose of the monthly payments to own the technology solution, or is the purpose of the monthly payments to use the solution? Historically, if customers financed their technology equipment and solutions, it was almost always a loan or a lease which resulted in ownership of the solution equipment once payments were complete. And those finance programs absolutely have an interest rate associated with them. And you can calculate that interest rate as we illustrated a moment ago. However, the primary purpose of technology as a service payment programs is to provide the use of the technology solution. These subscription programs do not result in ownership, and at the end of the term, the customer either renews the subscription or they don't. If they don't, then any equipment that was part of the solution must be returned. and therefore the monthly payment has no interest rate associated with it. To anchor this difference between own versus use in your mind, consider a couple of examples that you may find helpful in discussions with customers. For example 1, let's say you are approved for a mortgage loan to buy a house. You will make a series of payments over a specified term with the expectation that you own the house at the end of those payments. Naturally, among other details, you will want to know the interest rate on the mortgage loan you are approved for. But let's say you are approved to rent an apartment. You will again make a series of payments over a specified term. Do you have any expectation of ownership? Is there any indication of an interest rate associated with your monthly rental payment? Of course, the answer is no. You are only paying for the use of the apartment. There is no interest rate for this type of payment. For example 2, let's say you get an auto loan for a new Mercedes. Again, you have a set number of payments over a specified term with the expectation that you will own that Mercedes at the end of those payments. And again, one of the details about the auto loan you will want to know is the interest rate. However, let's say you and your family are going on a month-long cross-country road trip vacation, and you plan to rent a Mercedes van for that trip. You are provided a weekly rental payment, but you're only using the van for your trip. You will return it when the vacation is over. The rental agreement will make no mention of an interest rate because interest rate is not applicable to use-based payment agreements like this. From a big picture perspective, subscription services are another form of use-based solutions which simply do not have an interest rate. Whether it is a consumer-based service like Netflix or home internet service, or commercial solutions like phone service or Zoom, there is simply no question about or expectation of an interest rate associated with the monthly payment. Technology as a service payment programs are no different. Let's sum up these important details about interest rate when selling as a service solutions. For payment programs that have an interest rate, there are several common mistakes customers can make in calculating that rate. Fortunately, a simple web calculator with the correct inputs can make this quite easy. If a payment program results in ownership, it will have an interest rate. Subscription programs like technology as a service do not result in ownership, and they will not have an interest rate. And finally, it is our collective responsibility to help customers understand these details so they can make informed decisions about their technology needs. Thanks for joining, and be sure to view the remaining video sessions.